Imagine a world where contracts execute themselves automatically without the need for intermediaries or lengthy negotiations. Picture this. You're buying a car. Instead of signing paper after paper, you simply agree on the terms with the seller, and once the payment is made, ownership is transferred instantly through a digital handshake, all governed by a smart contract. This is not science fiction. This is the potential reality of smart contracts. So what exactly are these smart contracts? At their core, smart contracts are self-executing agreements, with the terms of the agreement directly written into lines of code. They operate on blockchain technology, a decentralized and secure digital ledger that ensures all transactions are transparent and tamper-proof. Unlike traditional contracts, which can be cumbersome and require trust in third parties, like banks or lawyers, smart contracts eliminate the need for such intermediaries. They automate the entire process, reducing time, cost, and the risk of disputes. But let's explore this further through a real-world scenario. Imagine two businesses entering into a supply chain agreement. Traditionally, they would draft a contract, negotiate terms, and have it reviewed by legal experts. This process can take weeks or even months. Now suppose they decide to use a smart contract instead. The terms, delivery dates, payment amounts, penalties for late delivery are all coded into the contract on the blockchain. Once the goods are delivered and verified, the system automatically triggers the payment. No delays, no misunderstandings, and no need for a lawyer to interpret the terms. The implications are profound. In a traditional financial system, power often rests with those who control the process, the banks, the lawyers, the regulators. But in a world powered by smart contracts, power shifts to the individuals who can create and deploy these contracts. Anyone with basic coding skills could potentially participate in this new financial landscape. This raises an important question. What changes when we take this premise seriously? If smart contracts can indeed democratize access to agreements and transactions, who stands to benefit, and who might feel threatened? The strange consequence is that while this technology holds the promise of empowerment and efficiency, it also challenges the established order, forcing us to reconsider how we perceive trust and authority in financial systems. What if we could trust in code rather than people? The transformation is not just technological, it's philosophical, pushing us to rethink our relationships with contracts and each other. What if every financial transaction was visible to everyone, reducing fraud and corruption? Imagine a bustling marketplace where every exchange of goods is accompanied by a transparent digital ledger, accessible to all. This is not merely a fanciful thought. It's the essence of how smart contracts could reshape our understanding of transparency in finance. Unlike traditional systems, where paperwork and intermediaries obscure the flow of information, smart contracts operate on blockchain technology, which inherently allows all participants to verify transactions independently. Think of it as a glass house in a world of opaque buildings. Every deal, every exchange laid bare for scrutiny. With this clarity, the strange consequence is a significant reduction in fraudulent activities. When everyone can see the transactions, the incentive to deceive diminishes. But let's consider a concrete scenario to illustrate this potential. Take the case of a supply chain finance system employing smart contracts to streamline operations. In this system, each step from sourcing raw materials to delivering the final product is recorded on a blockchain. Suppliers, manufacturers, and retailers can all access the same information in real time. There's no waiting for a bank to approve a payment or for an auditor to verify compliance. If a supplier ships goods, the smart contract automatically triggers payment upon confirmation of delivery. This efficiency not only speeds up the process, but also ensures that everyone involved can track the payment flow, creating an environment of trust. Now, let's imagine the old way of doing things. In traditional supply chains, a myriad of intermediaries are involved, banks, auditors, and brokers, all adding layers of complexity and potential points of failure. Disputes over payments can arise, and with them the shadows of mistrust. Each party might have a different version of the truth, but with smart contracts, the truth is immutable and universally acknowledged. It's like having a referee in a game who is not only neutral, but also has access to every play made throughout the match. The implications are profound. As this technology gains traction, the financial landscape could shift dramatically. Companies that adopt smart contracts may find themselves at a competitive advantage, able to offer faster services with lower transaction costs. But what about those who resist this shift? Established financial institutions, accustomed to their powerful positions, might feel threatened by the transparency that smart contracts bring. They may argue that not all transactions should be public, raising concerns about privacy and security. However, the trade-off is worth examining. While personal details may remain confidential, the overarching transaction data, like the amount and parties involved, could be available for public scrutiny, thus maintaining an essential balance between privacy and transparency. The challenge lies in navigating these waters, as society must decide what level of transparency is acceptable. So, as we ponder this new financial paradigm, we must ask ourselves, how comfortable are we with the idea of witnessing every transaction, and what does that mean for trust in our financial systems? Could it lead to a healthier, more equitable marketplace, or would it expose vulnerabilities we're not yet prepared to handle? What if you could launch your business without the need for a bank loan? Imagine a young entrepreneur named Maya, who dreams of opening a cafe in her neighborhood. She has a unique vision, but traditional banks require extensive documentation, a solid credit history, and collateral that she simply doesn't have. This is where the power of smart contracts comes into play. Rather than facing the daunting barriers of conventional financing, Maya turns to blockchain technology. With just a basic understanding of coding, she creates a smart contract that outlines the terms for her cafe's funding. This digital contract automatically executes when certain conditions are met, such as receiving funds from interested investors. There's no lengthy approval process, no bank fees, and no intermediary to slow things down. The strange consequence is that Maya's dream is suddenly within reach, not just for her but for many like her. What if anyone with an idea could find the funding they need without being bogged down by traditional financial systems? This is the level playing field that smart contracts can create. By lowering the entry barriers, they empower individuals and communities who have often been overlooked by the financial sector. Through platforms built on blockchain, anyone can establish a smart contract to fund projects, lend money, or even create decentralized marketplaces. Imagine the innovation that could flourish in underserved communities if they had the tools to finance their ideas directly. As we consider this shift, we must ask ourselves, who stands to gain the most? The answer is clear: those who have historically been excluded from traditional financing. Conversely, what happens to the established financial institutions? They may find their roles diminished, as more people like Maya choose to take control of their financial futures through self-executing contracts. However, this democratization of finance is not without its challenges. While smart contracts offer unprecedented access and opportunities, they also raise questions about security, regulation, and the potential for misuse. What safeguards need to be in place to protect individuals from fraud or exploitation in this new landscape? We must navigate these waters carefully, considering both the immense possibilities and the inherent risks. As we explore the implications of smart contracts, let's hold on to the vision of a world where anyone can bring their entrepreneurial dreams to life, free from the constraints of outdated financial systems. In this scenario, the financial world is not just a place for the privileged few. It becomes a fertile ground for creativity and resilience, empowering individuals to rewrite their stories and reshape their communities. Imagine a world where the very fabric of finance is challenged by a technology that operates outside the traditional boundaries of power. Picture this: a vibrant marketplace bustling with innovation, fueled by smart contracts, where transactions occur seamlessly, without the need for banks or intermediaries. Now consider the response of the established financial institutions, the very gatekeepers of our economic systems. What would happen if these traditional powerhouses felt their grip slipping away? The strange consequence is that they may not sit idle. They might react aggressively to preserve their influence. As we delve deeper into this power struggle, we must ponder the implications of such resistance. How might banks and governments respond to a technology that threatens their control? Would they embrace it as a tool for modernization, or would they push back with regulatory measures designed to stifle its growth? Let's explore a recent example that sheds light on this tension. Not long ago, a popular smart contract platform faced scrutiny from a government regulatory body, which proposed stringent guidelines aimed at curbing its operations. This move was framed as a protective measure for consumers, but beneath the surface, it revealed an underlying fear of losing control over financial transactions. Imagine the platform's founders, who had envisioned a decentralized future, now grappling with the reality of compliance and oversight. They found themselves at a crossroads: adapt to the regulations and risk compromising their ideals, or resist and face potential shutdown. This scenario illustrates a broader trend. Established institutions may seek to regulate or suppress smart contracts to maintain their power. The adaptability of these institutions will determine the future landscape of finance. Suppose banks decide to pivot, leveraging smart contracts to enhance their services. They could integrate these technologies into their existing frameworks, offering customers the best of both worlds: efficiency and security. Conversely, what if they choose to double down on their traditional models, viewing smart contracts as a direct threat? This could lead to a fragmented financial landscape where innovation is stifled by outdated regulations. The tension between innovation and regulation is palpable, and it raises critical questions. Who benefits from the status quo? Who loses? As we ponder the future, we must recognize that the fate of smart contracts may hinge on the willingness of traditional institutions to adapt. The balance of power is shifting, and with it comes the potential for a new financial paradigm. Imagine a future where smart contracts flourish, where they are not just a tool for the few, but a means of empowerment for many. What would that world look like? Or would it introduce new challenges? The answers are not yet clear, but one thing is certain: the struggle between decentralized finance and traditional power structures is just beginning. As we continue this exploration, we must remain vigilant, questioning the motives of those in power, while envisioning a future where financial systems can truly evolve, benefiting everyone equally. What if we could envision a world where financial systems operate not just efficiently, but equitably? Picture a bustling street, alive with the sounds of diverse businesses thriving side by side, each one empowered by smart contracts. Now imagine that these contracts eliminate the barriers that have long kept many individuals and small enterprises from accessing the financial resources they need. In this future, every person, regardless of their background or location, can engage with financial systems on equal footing. This is not mere fantasy. It's a potential future shaped by the widespread adoption of smart contracts. These digital agreements, self-executing and built on the principles of transparency and decentralization, could redefine our understanding of finance. They promise a landscape where trust is embedded in the very fabric of transactions, rather than reliant on intermediaries who have historically controlled access to capital. But let's pause and ask ourselves, what would this mean for society as a whole? If financial systems became truly equitable, benefiting everyone equally, we would see a seismic shift in how wealth is distributed. Imagine a young entrepreneur in a developing country, accessing funding through a smart contract that allows her to bypass traditional banking hurdles. Instead of being sidelined by a lack of resources or credit history, she can secure microloans from a decentralized pool of investors who trust the smart contract to ensure fair repayment terms. The strange consequence is a flourishing of innovation and creativity, as diverse voices and ideas find their way into the marketplace. But this scenario doesn't come without challenges. The evolution of financial systems depends not only on the technology itself, but on societal acceptance and adaptation. Would people trust a system that operates on code rather than human oversight? Would they embrace a financial landscape where their transactions are visible and immutable? The questions loom large as we consider the implications of such a shift. Moreover, what happens to the traditional financial institutions that have long held the reins? If smart contracts democratize access to finance, how will these institutions adapt to survive? We could find ourselves in a world where the very notion of economic power is redefined, where traditional banks must innovate or risk obsolescence. Yet this transformation could also lead to unintended consequences. As financial systems become more decentralized, who will be responsible for ensuring ethical practices? Without a central authority, the risk of exploitation or fraud could shift to new forms, challenging our understanding of security and finance. In this landscape, we must remain vigilant, questioning the motives of those who seek to exploit the system, even as we celebrate its potential. So let's return to that vibrant street, now pulsing with opportunity. What if every individual had the means to participate in the economy? What if the barriers of inequality crumbled, and financial systems became not just tools for wealth accumulation, but vehicles for social change? The potential is vast, but it hinges on our collective ability to navigate this brave new world, to ensure that the promise of smart contracts is realized in a manner that uplifts all of society. As we look ahead, let's keep asking ourselves, How can we harness this technology to foster a truly equitable financial future?